Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go in, dive in, look at some ratios, some last bull market performance. When we would be doing our swapping if we wanted to swap some metals or swap some assets. We're going to talk a little bit about um, risk versus reward, kind of looking at how to size these things up perhaps. Obviously, I'm not like a portfolio manager in terms of like I'm not a portfolio setup expert, but you can kind of think of some things through. What are some things to think about? How am I setting my portfolio up? And obviously, it's not advice to anyone else. It's just me and my opinions around it. But we can cover a lot of this stuff, and I'll show you kind of when these things peaked out against each other. And it's not that intuitive, to be honest. It may surprise you when things peak out because it might be earlier than what you think. And just because it peaked in the last bull market doesn't mean that this bull market's going to play out the same exact way. It may rhyme, but it may not be the same exact way. Assets may perform a little bit different during this cycle versus the last cycle. So let's dive in here, and I'll give you my financial opinion, guys. And someone, I just want to bring this up too. Someone brought up that uranium was outperforming platinum, and that uranium is also a very good deal. I agree. Uranium is an incredibly a good deal. But that area carries a little bit more risk. And that's why I want to talk a little bit about risk and what risk is. And well, I guess I'll just kind of talk about risk real quick. Risk is basically, I think it falls in a couple of categories. Risk is not knowing what you're doing to some extent. That is a risk. And even if you know what you're doing, there's going to be risks out there for companies versus a commodity. So you can have a commodity that goes up, but the companies are at risk of nationalization, of increased taxes, of certain things going wrong, hurricane, weather, et cetera, et cetera, et cetera. There's so many risks that are not known before you enter that position that will be known as you're holding it for whatever the reasons are. So I'm going to talk a little bit about risk too as we go along. Not that I am a risk expert by any means, but we can dive in here, and I'll just start talking about ratios and kind of some observations that I made. So this is a platinum gold ratio up top. We've got gold price in the orange. We've got platinum price in the teal, silver price in the gold price, gold color, and then the bottom in purple is crude oil. What you can see here, just basic observation. The beginning of the bull market occurred in 98, 99. That's this beginning here. Platinum was a strong outperformer in the beginning of that bull market. So we saw a drastic move of platinum all the way to a ratio of 2.3 against gold in a very quick move in the beginning. Now that's this move here in platinum. It doesn't look like it's a very big move, but on a ratio perspective, it is a big move. So let's say you're at 2.3. What do you do next? Do you go into gold? Do you stay in platinum? This ratio is now expensive. What do you do? Well, I think the first thing you want to do is you say, okay, we're expensive against gold. Well, we need to check other assets. So is platinum expensive against palladium? Well, no, we're not, because it's all the way down here, and we have a long way to run higher. So platinum is still cheap against palladium. And what about silver? So platinum is still cheap against silver, even if we're kind of at this peak here. We're still at a ratio of 130. So that's kind of expensive. It's not earthly expensive, but it is getting a little bit more expensive against gold and against silver. So platinum was kind of the first mover. It's still cheap against palladium, as we can see. And at that time, in 2000, 2001, we can do a platinum to crude oil ratio just to see what that looks like as well. I'm going to kind of zoom it all the way over here. And the beginning of it was 99. It was cheap down here. Platinum was cheap against all these different assets. And it went all the way up to about 04, where it got more expensive, 25 ratio. So we were cheap against palladium, and we were still cheap against crude oil. But we were expensive against gold at that time. So, you're going to have to make a difficult decision. Do we swap into gold here at the top, or do we just ride it? I think the right move is to ride it on higher here. Obviously, looking back with 2020 vision, super easy decision because we know what happened. Some obvious glaring things here. From 99 to 2008, we saw a good performance of crude oil. This is a big move. We also saw a very big move out of platinum. And then the big moves out of gold and silver came after the 2008 crash. So one could say that platinum and crude oil and uranium as well are earlier performers. They perform very well earlier in the bull market. They are also very hard runners. They have very good outperformance in short periods of time. So I think when you're looking at the beginning of the bull market, if you were to say what assets perform well in the beginning of a bull market, you would say that crude oil looked like it did pretty well. Same with platinum. Those are two assets there. Natural gas, you could throw natural gas up here too. I'm curious to see how this looks as well. There's natural gas on the bottom. You could say natural gas also outperformed incredibly well in the beginning of the bull market. On the bottom there in the light purple. So we're also seeing crude oil, natural gas do very well in the beginning. I am positioned very heavily in the things that do very well in the beginning of the bull market at this time. Those things are natural gas companies, crude oil companies, uranium companies, and platinum. I do still own some silver. I do still own some gold. I'll never sell all my gold, but I am heavily weighted in the things that perform well in the meat of the commodity bull market. But as that commodity bull market progresses, we may want to look at other opportunities that are out there. So one of those other opportunities is silver. We could see a vast outperformance of platinum all the way up to the peak of silver. Against silver, at least the ratio. We went from a bottom of about 60 all the way to the top of about 148. Now, let's just say that we got in around 70 and we rode it to 140. It's a double. We would have doubled our metal holdings owning platinum versus silver at the beginning of the bull market versus kind of the 2003 timeframe. And hypothetically speaking, if we purchased our platinum down here at $350 an ounce, I'm just going to make that a nice even number. So we take a $10,000 position in it, hypothetical position divided by 350, you've got 28.57 ounces that we purchased in this general location down here. We rode it all the way to the top, and we said, you know what, I'm just going to swap it at 140. So we swap it at 140, so that's 140 times that 28.5. We have 4,000 ounces of silver. So we take our 4,000 ounces, we ride the rest of the bull market all the way down to, we hit a bottom here, and then we come back up and we sell it when it came back up here. Let's just say it's at this general location there. So looking at that, silver was like $35. So let's just say we sell our silver and we walk away from the trade. So that's times $35. And we had 140,000. So that's 14 times our original purchase price at the beginning of the bull market. So we bought here in 99 or so, and we sold it here in 2011 at $35. We didn't get the peak. Okay, we missed the peak, whatever. We sold it on the way back down at $35. So we have $140,000 from a $10,000 investment. So the question is, what risk did you take doing that? What was your risk? Well, did you have inflation risk? Did you have deflation risk? No, not really. I mean, if we had a really bad inflationary period, you're in the thing that you want to own, which is metals. Deflation, yeah, everything drops together, but it's okay. It's not the end of the world here. It's still an asset and it still has value against other things. So you've got no management risk. You've got really no currency risk. You've got, I guess someone could steal it. That's about it. Your risks are really low playing the physical metals game. And I just showed you a way over a 12-year period to 14 times your money. I don't know what that is on return. I'd have to calculate it, but you're probably beating mainly everyone in the market, especially if you can take oversized positions in it because the risk is so low. So with a large portion of my net worth, I'm playing the strategy because of that. It's the risk that you're going to have to take to beat it, which I think may or may not be worth it. Now, could I beat it 14 times your money? You can, but you're going to have to take on risk. That's kind of this here is my baseline. Like if I wasn't taking a ton of risk using precious metals, this is the baseline. This is what you're going to have to beat. To beat a 14 bagger in a 12-year period, it's definitely doable. But it's you're going to have to take some risk, and it's going to be it's not going to be easy. It's doable, but not easy. You're going to have to start speculating, most likely in equities, and some of the large cap equities will not beat this. So you're going to have to look at windows where the commodity outperforms and the equity outperforms during that time frame, and getting the timing right may or may not work. The back half of the commodity bull market in precious metals, the mining companies underperformed. They did not perform as well as the underlying physical metal. So in a world where things get a lot more scarce, maybe the commodity outperforms everything else. It'll even outperform the miners. We can see that some of the mining companies they're losing some of their production. They've got depleted fields. So how do you know if you're in a mining company that has depleted fields versus one that can grow at the right time, at the right, in the right time, at the right space, in the right place, et cetera, et cetera. You've got countries, if you come into a scarcity of commodities, I don't think countries are going to let these guys make a ton of money, and just let them walk away with it. I think there's going to be higher taxes. I think there could be nationalization. I think there could be borders that get shut down, or companies with stranded assets. Who knows? Your risks go up when you have to speculate in some of these equities. Is the risk in speculating in a lot of these equities worth it? I don't know. I'll have to find out. I get pretty overweight in companies that are in really good countries, in good jurisdictions. I know if you kind of listen to Marion Katusa, he always talks about swap lines. Anything with a swap line is probably a good spot to be. Maybe that's a good way to evaluate your jurisdictional risk. Maybe it isn't. I don't know. A lot of the assets may not be in the swap line areas, and that may or may not be good for that commodity, and it may or may not be good for the company that you are looking at to invest in. Maybe your risk goes up exponentially versus the physical commodity that you can hold, like a physical precious metal. And then you have to balance, is it worth the risk? And maybe you should portfolio allocate it in a way where you've got the risk adjusted returns. So how do you calculate that stuff? And a lot of it, I don't think there's like anything like that you could hard calculate with it. It's kind of a touchy-feely, it feels like this type of risk assessment to some extent. Yeah, you can throw in a bunch of numbers, but I don't know if those numbers are going to capture the necessary, probability of outcome. So it gets real wishy-washy on, what's the risk of this being nationalized? Who knows? Who knows at that point? So the way that I always kind of looked at it is I said, well, this is a lot of uncertainty in certain investments and equities and stuff like that. So I just allocate it a lot smaller. That's all I do. And then I take a kind of a diversified approach, not like watered down completely, but maybe I take 4, 5, 6, 7 positions, overweight the heck out of them, go to what I think are good jurisdictions, and say, you know what, I'm going to allocate this amount of money to it. And that's what I do for the most part. And then on these ones with very low risk, this is where I pummel a bunch of money in. So perhaps platinum, if you were to look at like a single position platinum size of physical metal, may be as big as my entire oil and gas portfolio at the moment, or something on the lines of that. So that sector that I've allocated and have diversified, around and has already made a bunch of money, may be as big as my entire platinum portfolio, or maybe it's a little bit bigger, but the oil and gas side, just because it's gone up so much. But that's a way to kind of look at it and measure that risk. Is 14 times your money good enough? If it's good enough, then why even introduce the extra risk? And I'm not saying that 14 times is, your money is in the bag. It's not in the bag. There's obviously things that can happen to that sector or to that metal from a fundamental perspective. But I also think that there are rare alignments in history where a metal or an asset gets cheap against everything. And that's generally when they perform the best. Again, it was rhodium in 2016 that was a clear outperformer. Palladium in 2009 was incredibly cheap against all the other metals. That is also a metal that does very well in a disinflationary time frame. So we have that disinflationary time frame coming from 2009 onward. And right now, platinum's the cheap one against all the other metals. Now, someone brought up uranium, and uranium is cheap to platinum, and uranium's cheap to all these other metals as well. That is also why I have an allocation to uranium mining companies. But the equities carry a lot more risk. They carry risk of dilution. They carry risk of permits and licenses and stuff like that not going through. There's a lot of risk there. So it's not my largest holding. It is allocated of my equity side. In some of my portfolios, I've got up to maybe about 30%. That is not 30% of my net worth. My physical metal holdings is probably 20-something percent of my net worth. And then I've got, real estate that I own. And then I've got the equity portion, which is like 401k, other investments, Roth IRAs, and individual accounts and stuff like that. I'm talking about 30% of some percentage of those in the equity side, not of my entire net worth. So, and then I've got a very high percentage in oil and gas, and then I've obviously got percentages in gold and silver mining companies and royalty companies and stuff like that. So when looking at all this, I think when you kind of look forward, you kind of have to understand that the ratios, they don't all peak out at the same time here. And obviously this one peaked here in 2003 or so, the platinum to silver ratio. And you can see that all the US dollar prices peaked later. But this peaked earlier. And that is where I think things may not be as intuitive. So we may be swapping some assets before the bull market is over, before it peaks in US dollar terms. We get the outperformance in the beginning, and then we swap to one that's underperforming that has a lot of outperformance towards the end of the bull market. And again, it may not behave that way. And that's why I don't put all my eggs in one asset. I split it up, I move it around. I don't need to win on everything. And I don't need to capture the entire move on everything that I have. Obviously, that's the goal. But in order to win big, I don't have to capture every single move of every single little thing. I can take 3 or 4 sectors, diversify across those 3 or 4 sectors, pick some companies that I think could go ballistic in it, pick some really low risk ways of playing it, diversify across, and win big just by hitting on any one of those winning. There's going to be some fallout. There's going to be some ones that don't do anything. There's going to be some ones that go to zero. It's part of the game. And I've had some go to zero. I own Norilsk Nickel. It's a Russian company. Gone. Did my portfolio get devastated by it? Nope. Nope, it didn't. It didn't even really, I didn't even see it. It was like a little blip on the map as it went, because everything was going up at that time. So there, yes, I've had companies go to zero. There's been ones that fall out. I've been diluted, as expected, and companies will continue to dilute if they do not create cash from their business. If you're in companies and you don't want to take that risk, and a lot of the ones where I've made a lot of money are the ones that they had all the infrastructure in place, they had a bad time, and their commodity was incredibly cheap against all the other commodities, oil in particular. Oil went to a negative number in 2020. And I was like, man, this is going to be big on the opposite side. So I just waited for everything to kind of unwind and then bought it after it unwound, after that March crash. I did it a little bit after. So I think those have the best risk reward returns in equities are companies that have all the infrastructure in place. They used to generate boatloads of cash in the right market conditions. They got hit to the downside because of the commodity itself. Now you're playing a gigantic leveraged play with cash flow companies to the commodity itself. That has been my most successful investments myself. I feel like those are the highest reward, lowest risk opportunities in the market, bar none, period. And all you're waiting for is the market conditions to change for the commodity to become favorable again. And if we can accurately identify when the commodity is cheap, and we can see that things are improving, maybe they even printed money on top of it, which is great, especially if it's an inflationary sensitive asset. Then you've got that alignment that you're looking for to take on more risk in a certain sector than what maybe you normally would. So we're looking for these alignments in market conditions, ratios, valuations, and all this stuff. And then when you look at this stuff, I really think that risk is important. A lot of new investors or retail investors, they take on far too much risk, far too much risk. So if I were to kind of, let me pull up something here. I'll just kind of make a point. This is the way that I understand it, at least. So, like, let's just say this is just some paint, guys. A lot of people, they've obviously, let's just say that this is a graph. So here's an axis there, and then another axis. Another axis is down. Oops, got to hold it down. Another axis here is this guy here. All right. So one of these is a reward. One of them is risk. If I were to just draw a line up here, make it pretty easy, you're going to get some sort of risk reward that looks like that, right? Your reward, it doesn't matter which one's which. This could be your risk, and this could be, or sorry, you know what? Let me reverse that. So your risk is here, and this is your reward. It's hard to write there. Let me make the size a little bit bigger. So we're coming on up. There's your risk reward. What I'm trying to do is I'm trying to get up here where your risk is still low, but your reward is really, really high. So maybe, there would be a good spot where you don't want to take on any more risk than here, but your reward to take on more risk is like nothing up here, right? It's that delta there. What I feel a lot of people are doing is they're saying, well, I want the most amount of reward. So they go out over here and they just take on all this risk for basically this much reward between those two lines here. So in my opinion, this here is not worth the risk, that delta here. And if I want to get even more creative, what I'd like to see is perhaps a setup where the curve looks more like that, right? Where you've got like very little risk, but your reward is way up here. This could be like a physical precious metal where your risk is very low. Like it's like the sector, it's sectional, sector risk of whatever that commodity is, but the actual thing you hold doesn't have much risk. Or maybe I can draw it a little bit different. Maybe it looks something like this, right? Or something like that. So this could be like gold here. This one could be platinum up here. And your risk is still like really, really low in both of these spots here. But your reward on one of them, because the metal is incredibly cheap against all of the other metals, is something that you want to play. And maybe there is a little bit more risk. Maybe there isn't more risk. But I'm just giving you kind of examples. And maybe I don't have these drawn perfect. Maybe this one is more like this. And this is platinum and this is gold. So gold's got less risk, platinum's got a little bit more risk, but it's got a little bit more potential here. But the risks are so low in relationship to all this other stuff that it's worth taking that extra risk for it. So that's really what you're balancing here, is you're balancing risk reward. And I think what is happening is everyone is going far. There might be one that looks like this, and they're going way out here to try to get this return out here. But the risk of that occurring, like the risk of something bad occurring, of this reward not potentially panning out, is so great that they're taking everything they've got and piling on too much risk. So when you look at and evaluate companies, and I'm not saying that this is a perfect way to describe it, I'm just saying evaluate your risk. And if you're not looking at risk at all, then you're probably not going to get the desired outcome that you want. One thing that I've noticed over these long periods of time is under certain market conditions, I'm going to just take this off here. So under certain market conditions, this curve changes. And that is where you make all your money. So this is, let's just say that this is like the standard one of oil and gas. The thing that can happen though is your perceived risk down here changes based off of market conditions. If the commodity crashes, the perceived risk of the companies and commodity companies that are in that commodity sector, it goes up and this curve changes. So it distorts this curve. And the curve, I'm trying to think of how it would distort. It's not like I've read this in a book, guys. This is just things that I've seen and how these sectors behave over time. Your risk can go down and the rewards can remain very big. So for instance, oil and gas companies were actually very risky buys at the bottom of 2020. But the rewards were also incredibly big. So if we were to look at this, at that time, it looked like probably something that looks like this. It's like they could go bankrupt, and some of the companies that you were buying, if you bought like kind of the ones that were real close to bankruptcy, if they didn't go bankrupt, your rewards would have been huge. Up here, if you got a couple that were really good. Now, the big companies, we knew that they were not going to be sold off as much. They knew that they weren't going to go bankrupt. So they're down here. Your reward and your risk was not, it just wasn't there. But all your highly leveraged, high-end debt ones, when the commodity goes down, they could go bankrupt. So there were some companies on this right-hand side that were just ridiculously priced to the downside. You could pay pennies on the dollar for that. But it was very risky because they could go bankrupt if the commodity did not come back into, we'll say it, profit for them. It didn't go over their break-even point. And that is where the money could have been made. The profile now, even though the commodity prices come back, I don't think the risk reward is like that anymore. I think that the risks are far lower, but your returns could be pretty high. So I think it's something like, how can I say it? It's probably like this, where your risk is really low, but your reward could be very high. I have to redraw that. It's something like this. We'll say it like that. There you go. So you have lower risk. They all migrated this way, but your rewards are still there because we've gone through a period where they had high cash flows, and the risk was sucked out of the company. So now you're paying a very good price for the value of the company. So your reward can still be massive. If we get a gigantic move in the oil price, you can still get 5 times, 6 times, 7 times your money potentially in some of these smaller cap companies. And I think a lot of the risk has been sucked out of it. So, and I'm not talking about small micro cap type stuff. I'm talking 400 or 500 million, 600 million market cap, 1 billion, something like that. And I think what needs to happen is you need to find and need to like kind of realize that risk reward return. You want to go after very low risk, very high rewards, and there's these sweet spots that you kind of find out over time. You look at other companies and the risks are too great for the rewards. Even if there's a slightly bigger reward, your risk goes up too much at a pace that's greater than the reward. So now you're taking on far more risk and you're not really accompanying that with the reward. So depending on how you look at all this stuff, you want to maximize rewards for the risk that you take. And I think if one overweights reduced risk, I think you may get better returns than what you think if you play it really smart. So what I mean by playing it smart, if you buy at the right time, you buy in the right sectors, and then you've got the ratios that are cheap, and then you catch these things kind of in the right areas. I think that your risk rewards will pay out even going with a little bit larger companies versus piling into companies like junior silver companies that don't have any money, that cannot produce cash flow because their exploration. They're going to be sucking money. They're going to be sucking your money that's in it versus paying you money to be in it. So there are larger cap companies, diversified mining companies, some of the large cap oil companies that are just incredibly good value, and they will pay you massively to hold their company, to hold their stock. And if the price of oil goes up, they're just going to pay you more money. That is the type of setups that I like to see. And even some of these mid-sized companies, small to mid-cap companies, they've got good cash flows, and you're paying very cheap for the company for shares at the cash flows that they have. And if the upside potential is there, their cash flows could dramatically increase. Those are the companies that I look for. Those are the ones that I think have the best value. So that's kind of the way that I view things. And yes, people can disagree with it, but it's finding the sweet spot of risk and reward. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. I have identified a lot of the good risk-reward companies. We talk about this a lot on the website. And this is where I think people separate from the returns. Their returns so you can be in some of these sectors and the returns can be dramatically different between people because of the companies they've overweighted and when they bought them. That's what really separates a lot. So that's what I've got for today, guys. Hopefully you learned something from this and you look at things a little bit different than you did before. All right, we'll catch you next time. This is Finding Value.